We begin with the global energy landscape, where major shifts are underway as OPEC production hits a major milestone, while Nigeria ramps up strategy to hit its ambitious output targets. Our countdown begins in the global energy markets. Output from the Organization of the Petroleum Exporting Countries, OPEC, has plummeted to its lowest level in over 2 decades. Data reveals that production from the group's 11 state members dropped significantly by 1.06 million barrels per day in the month of May. This brings total output down to 16.13 million barrels per day. Market watchers attribute this sharp decline to ongoing strategic supply adjustment and escalating geopolitical tension. Analysts are already warning that this tightening supply could trigger a fresh rally in the international crude prices, potentially complicating global efforts to tame inflation. Back home, the federal government is doubling down on strategies to significantly scale up Nigeria's crude oil production. This is part of an aggressive drive to boost independent revenue streams and stabilize foreign exchange earnings. The Minister of State for Petroleum Resources, Senator Heineken, has mandated industry stakeholders to deliver a clear, time-bound roadmap to hit the national target of 2.5 million barrels per day. According to the ministry, this initiative is created to eliminating production inefficiency, restore investor confidence, and commencing Nigeria's competitive edge in the global energy markets. On the continent, Ethiopia's government say public spending will rise in 2026/2027 fiscal year to 14.7 billion, driven largely by costs linked to Iran war, including higher fuel subsidies and other crisis-related expenditures. Finance Minister Ahmed Shide said the increase reflects broader pressure on public finance, with spending rising from 1.92 trillion birr in the current fiscal year. Despite the high expenditure, the country expects the budget deficit to narrow down to 1.4% of the GDP from the 2.2% previously projected. Ethiopia also forecasts economic growth of 10.1% next year, while export earnings are expected to reach $10.5 billion. The government continues debt restructuring with Eurobond creditors amid ongoing concerns about its financial stability. Finally, looking at Europe, the European Central Bank appears poised to adjust its monetary policy stance, with expectation high for its first interest rate hike since 2023. The anticipated tightening follows a resurgence in inflation fueled largely by volatile energy costs and heightened geopolitical tension involving Iran. Eurozone policymakers face the delicate task of curbing consumer prices without choking off fragile economic growth. Economists wonder ECB's decision will reverberate globally, impacting cross-border investment flows and currency valuation.